Welcome to SilverOak's quarterly webinar. My name is Shannon King, and I'm President, Partner, and Chief Compliance Officer of SilverOak. And with me, as usual, is Jonathan Charlo, a partner of the firm, as well as our lead analyst. This webinar is scheduled to last approximately 45 to 60 minutes, and a copy of it will be posted to the SilverOak website shortly afterwards. If you have any questions throughout the webinar, I encourage you to contact your SilverOak advisor after the session ends. If you're not working with a SilverOak advisor, feel free to contact me directly at 952-896-5701. And of course, Jonathan, I want to thank you and the rest of the SilverOak team. I know it takes a lot of effort to pull all this information together and to get it presentable. So thank you to you and to everybody involved, including on the technology side. For compliance purposes, I must note that we will be discussing the overall markets and economy during this webinar. And in doing so, we will be providing our interpretations and perspectives. You should not rely upon this information as fact when making any investment decisions. Also, we'll not be discussing specific SilverOak portfolio performance, as each of our clients' portfolios are customized. Nonetheless, all of our clients should have received their quarterly performance reports by now. If you have any specific questions with regards to those reports, please reach out to your SilverOak advisor if they have not contacted you already. And lastly, past performance is no guarantee of future success. So with that, Jonathan, let's take a look at the agenda for today. We're going to start discussing the economy and going through the SilverOak dashboard. We'll transition into a discussion around market performance, and then really think ahead and go through kind of what our outlook is over the next few quarters or year. We'll provide some SilverOak updates. And then, of course, since we are into a new year, we'll talk about some new year planning tips. I would like to remind everyone on today's webinar that if you have any questions, again, reach out to your SilverOak advisor. But if you have any topics that you would find of interest, please share that with your SilverOak advisor as well. We're always looking for topics that we think may be relevant to our clients and to those attending the webinars. So let's start with the economy and the dashboard. As everyone knows, our dashboard's broken out into four major components. The first being the economy. And Jonathan, if we look here, we can see that the fourth quarter, which by the way this is laid out is by quarter, going back to the third quarter of 2020 on the left to projected amounts over on the right. If it's green, that particular quarter is considered to be positive for that particular component of the dashboard. If it's gray, it's neutral, and if it's red, it's negative. So as I was saying there, Jonathan, the economy for the fourth quarter we have coded as red, but we're projecting that it's going to go positive or at least neutral.
That is the projection, and so while we have one color of red going through the year, it's actually gotten a little less red, so to speak, less negative. And so we're actually very close to being neutral.
So even in the fourth quarter, we were quite close to neutral. We just had to pick between one of the two, and it had clicked over to the neutral.
Yep.
The second component of the dashboard is the credit markets. And here we're seeing that they have been neutral for a while, and we're projecting will maintain kind of their neutral position. Valuations, those are red. Do you want to touch on that? And I know we're going to touch on a little bit more detail in a few minutes as well.
We'll talk about that a little bit later, but essentially we had very good equity performance in 2023, and yet we actually didn't get a lot of earnings growth. So it is valuation expansion that drove the market, and so for that reason, that's why it's coded red.
The last of the four components of our dashboard is market sentiment. That has been green and continues to be green, so positive. But when we roll this all up together in one composite, the 6-month average remains negative, and we project will be negative in the kind of early part of this year, but then transitioning more neutral. At least that's the trajectory we believe. So with that, let's look at the dashboard, kind of going back in history and compare both the current dashboard numbers with the 6-month average dashboard. And here what we're seeing, Jonathan, is both have bounced off kind of their lows, but still haven't quite hit that red line that would indicate kind of more positive than, say, more negative.
Yeah, so we're on a current basis are just a little bit below that threshold. The 6-month number, which does lag, is coming up. And so at some point, as long as this trajectory continues in the same path, we would see the 6-month hit that threshold at some point in the next quarter or two.
And sometimes it's nice to reiterate that, you know, there isn't like a bright line per se that once it crosses, everything's great. And, you know, maybe on the downside, once it crosses going down, everything's terrible. I think it's more important the trajectory, and the fact that we are coming off the bottom is encouraging, although we're going to see that there are still some signs of relative concern as well. So Jonathan, let's look at some of these components of the dashboard in a little bit more detail, starting with the economy.
And so certainly here we're looking at the ISM Manufacturing Index. Manufacturing is actually one of the more negative factors within the economy. And what we're seeing is that the PMI is still in contraction territory.
How about unemployment? And by the way, I should remind everyone that on the economy, there's actually 11 different factors that go into the dashboard under that economy component. We're not going to go through all 11, but you've touched on one, and now we're going to touch on another component.
Right. So another component is the unemployment rate, and that, if you look at the detail on the bottom of the slide, has come up a little bit, but more recently has actually come down a little bit. So it's up off the bottoms, but typically in weaker economies, we might actually see a bigger spike. We're not seeing that yet. So on the margin, that's certainly a little bit more positive than what we're seeing in the manufacturing factor.
And since we're talking about the economy, it's hard to have that discussion without talking about housing starts.
So we have actually, if you look at the green line, actually seen a little bit of marginal improvement in the last few months. And I think to a certain extent, that is the fact that mortgage rates have come down off of their highs. Now, when we look at kind of the year-over-year growth, that's obviously come down, and housing has been a weaker factor within the economy, but perhaps if interest rates continue to come down through the year, especially if inflation does behave itself, we might see a bit more of a pickup in the housing starts area.
So let's transition from the economy over into the credit markets. And again, just as a reminder, the credit market component of the dashboard was neutral.
Yeah, absolutely. What we have seen, though, and this is what we're showing you, is that the yield curve is inverted, meaning that short-term rates are higher than long-term rates. And the reason economists track this is in the past, looking at different yield curves, it's typically measured against the 10-year yield, whether you use the 2-year or the 3-month. But typically, when those short-term rates are higher, it means that credit conditions are a bit tighter. And what we have seen on a lag is that the economy then tends to slow down and go into recession in many cases. Now, we haven't seen that yet, and we've been inverted now for about a year. Mm-hmm. But those who argue that there's still a chance or possibility of a recession or hard landing, as they say this year, it would be because of that lag, and that we're still in that period where we could perhaps see that lag in the first half of the year.
Right. Yeah, and I think the typical can be as much as 12 to maybe even as much as 18 or more months after the initial inversion that the recession occurs. So we're, like you said, still in that window period. How about spreads?
Well, that's an interesting thing because certainly when we look at spreads, that's really a bit more influenced by business conditions and kind of the current economy. And really what we're looking at here is that spreads have actually been coming down. If you look in the blue, that's kind of come down recently. And then the black is really looking at high yield or less than investment grade spreads. Those have steadily come down this year, suggesting that the markets look at the economy and are actually fairly sanguine about what's occurring. The reason we have that upward arrow and question mark is typically ahead of slowdowns, you would see the high yield spreads widen, meaning that the market is really fearing a major slowdown. Therefore, you need to have higher yields for riskier bonds to reward that risk that people would have in holding those bonds.
So let's go to valuations, which is the third component of the dashboard. And again, just to remind everyone, valuations was one of the components that was actually negative because, as you mentioned, markets in 2023 were quite strong, yet the earnings really didn't back them up.
Yeah, absolutely. And so earnings expectations last year started in the high single digits and ended up being up a little less than a percent. Now we did, from an expectation standpoint, bottom in the third quarter, and the expectation for the fourth quarter earnings is to be up a little bit. We're still in earnings season, so we don't really have a conclusion yet there. But the expectations for 2024 are currently for 11% growth. And typically you do see that expectation fall throughout the year. So we're not suggesting that earnings are going to bounce 11%, but perhaps if we get the direction right, we might be in that 5 to 7% range, which would be a bit closer to kind of the long-term average.
Sure. So then just drilling down on the last component of the dashboard, which is the market sentiment. And that one, as everyone may recall, was positive in the dashboard. So talk to us about sentiment.
Well, here we're sentiment. We're really looking at the market trend, or how has the performance of the market done. And quite frankly, last year we did see volatility, but had generally an up first part of the year and actually a very large rally in the fourth quarter. And so from that technical standpoint, the market performance itself is a bit strong. But momentum kind of is a factor in itself. And so from that standpoint, we enter the year with pretty decent momentum. And we're actually seeing a majority of S&P 500 companies above their 200-day moving average, which has in the past been fairly bullish for the market.
Perfect. So before we transition into market performance, I always like to kind of reflect on the economy, and of course, through our discussion so far today, it's a bit of a mixed bag. There's some components that are looking quite positive, others that may be a little bit more challenging, but I just like to remind myself and remind everyone how difficult it is, if not impossible, to forecast what's going to happen over the coming year. And I think back to 2023 and right at the beginning of the year, almost every forecasters on the economy, analysts, it doesn't really matter, we're all anticipating a recession. And yet we didn't see a recession. Now, it may be yet to come, as we mentioned, but I think at the beginning of 2023, most expected it certainly would have occurred within the calendar year, and yet it didn't. So it's always a nice reminder that, you know, even though it may look obvious and the future like is certain, it's almost never the case. And that's true with the markets as well. When we start talking about market performance, it's very, very difficult to predict market performance. And I don't think very many people, if anyone, anticipated 2023 to provide such strong performance across really all, or almost, I guess, almost all of the asset classes.
Because on the next slide, we're going to show you the one asset class that didn't
Yes.
perform as well.
Yes. But here we can see equity performance across the board, whether it's US large cap, i.e. big companies, US smaller companies, or even internationally emerging markets, all had very, very strong performance, obviously helped or buoyed by the really strong fourth quarter that we saw. And to your point, Jonathan, the one category that was negative both for the quarter and for the year, commodities. Okay, but that also probably helped play into lower inflation because commodities were down.
Absolutely.
Now, I found this to be a real interesting slide that Jonathan, you and your team put together, because what it's showing is it's showing on a calendar year basis the bear years over on the far left, the not so good or lost money years, the less than average years, the average years there more in the middle, then over toward the right, the better than average, and the great years in the far right. And of course, 2023 was a really good year. What I found particularly interesting about this, though, is that when I look back at those bear years, with the exception of the Great Recession, or excuse me, not recession, the Great Depression, not the Great Recession, was the Great Depression going back into the 30s. With the exception of those years, every year that falls in the bear year column is followed by a year that falls in the great year column. Every single one, with the exception of those in the Great Depression. I just found that quite astonishing. And of course, then I started thinking to myself, well, if 2023 was a great year, is the opposite true? Do great years then get followed by bear years or lost money years or less than average years? And the good news, Jonathan, there is no correlation, that you really cannot identify a trend in what the year following a great year is going to look like. In the last, maybe most recent half a dozen or so, one was followed by a lost money year, one by a better than average year. It's just been kind of all over the board. Okay. The other thing that's good here, look at all those years that are green, that are great years. I mean, very few years fall in the average. We're either better or worse.
Yeah, and another way to think about this too is, as we entered last year, I don't think anyone would have predicted a great year.
No, you're absolutely right. Again, getting back to that, it's just so difficult to know exactly what the economy and or exactly what the markets are going to provide. Well, let's talk about what did particularly well last year. And here you've given us a slide that shows growth leading value, i.e., let's think about more technology-oriented companies than, I don't know, financials. And we're seeing in large cap or big companies that growth obviously did better. True in value or a mid cap as well, where growth outperformed value. Not quite as distinct in small cap, but certainly still for the year, growth did have the slight edge over value. And then here, we'll see the concentration of returns. And I think this really is interesting, particularly as we talk about growth versus value. Why don't you share why growth had such a dominance in the year?
Yeah, so right in the middle, in the light blue, we're showing, the S&P was up 25, 26%. However, when we look at the Magnificent Seven stocks, the big seven tech companies, they were up on average 76%. And so they make up about a third of the S&P. And so, that really lifted returns, so much so that if you excluded those seven and looked at the remaining 493 companies in the S&P, it was up 13%. Now, that's not a bad return, but it's not
a lot different.
It's not the same. So basically, seven stocks were half of the performance in the S&P last year.
And there were periods last year where the overall S&P was up, but if you took out those seven, everything else was actually down. And this is year end here, but there were periods throughout the year where actually those 493 stocks really did nothing.
Absolutely. Certainly this looks better than it would have at mid-year. And again, this was driven by the strong, almost everything rally we saw in the fourth quarter.
Well, the other thing I want you to touch on, if you don't mind, Jonathan, is this large cap growth bias that occurred in 2023. Let's look at it maybe a little bit more historical perspective, because it's not as though those stocks have been outperforming every single year over the last couple of years.
So here, again, we're just showing you the magnitude of that return. That's what the upward arrow indicates. However, one of the reasons why they were up so much was because it was a recovery year following 2022 when they were down a lot. And so putting those 2 years together, there's just not as much performance difference between those big seven, Magnificent Seven stocks and the remaining 493 stocks.
Sure. Well, you were talking a little bit earlier about valuations, and of course we've included them in our composite as negative. Let's touch on that a little bit more detail.
So here, right in the middle, basically the dark green that we're looking at is the earnings, okay? And then the kind of light green shaded portion would be the valuation of the market. And so you can see clearly that valuation, again, dominated the performance and led to the performance in the market. And again, as we mentioned, earnings growth last year ended up being just a little bit above 1%.
So thus far, we've talked a lot about the U.S. equity markets. Let's touch on the international equity markets. And I think to a lot of people's surprise, it was, for the most part, relatively strong as well. Obviously, there's one outlier here, but everything, with the exception of China, had quite strong performance.
Yeah, Latin America certainly led the way. It had a very big Q4, which kind of added to their annual return. But I really think we should focus on the right. This might be a surprise to people, how strong Europe and China performance was.
Japan.
Japan.
Yes.
Exactly, Japan. It's been so many years that we've talked about
I know.
Japan.
I know. It's always been China, China, China,
Yeah.
and now it's Japan.
Yeah. So Japan actually had really good performance last year, actually slightly beating Europe. But I think with kind of the commentary we've had about the U.S. economy and the potential for a recession, with the Russian invasion of Ukraine, higher energy prices for Europe, I think the assumption was that Europe would be in a recession. And so here we look at what actually happened from a market performance. Now we did see growth slow in Europe, but didn't go into recession. But we saw basically the European markets up 20%.
Mm-hmm. Well, and even most recently, what's happening in the Red Sea, again, you would have thought that would really push up energy prices, but we haven't seen that thus far. So again, it's just something that looks like, oh, it's so obvious. I mean, if you thought that there would be ships attacked in the Red Sea and problems with the flow of goods and petroleum, you would have thought the price of all those goods would have at least moved up, maybe even skyrocketed. But we're just not seeing that. And part of that's our supply of oil.
Mm-hmm.
The U.S. is now net exporting rather than importing. In any case, let's talk about bonds. So everyone is well aware 2022 was a horrible year in the bond market. But 2023, as with equities, was a nice rebound year. So let's touch on these different sectors of the bond market.
Yeah, so I think the surprise in the fourth quarter was how strongly bond returns rebounded. Some cases it added to the 2023 returns. Now, certainly we did see in the fourth quarter more market-based interest rates come down, which led to this. But if you look to the right, you're seeing slightly higher returns, but higher returns, no doubt, in the high yield space. And again, a lot of that has to do with the fact that the credit spreads actually narrowed last year and didn't widen as many people anticipated.
Mm-hmm. But I would be a little cautious of that. And we're going to get into that when we talk about our outlook, is I'd be careful not to chase those high yield returns, because if we were to transition into a recession, those typically get hit the hardest.
Absolutely.
So I had mentioned 2022 being a terrible year in the bond market. It was like a historically terrible year in the bond market. But like with the equity market going from really bad to really good, that's what we saw with bonds. And it ended up being one of the best years in bond market returns.
And that happened, again, largely because of the fourth quarter, whereas on the left side of the slide, we're showing you those months where we had, negative month after month. And in fact, that was a historic 6-month period. So last year was historic, but in almost for two reasons, just how bad it started.
Last year being 2022.
23.
22 was so bad.
Well, right. But
Yeah.
what I meant was that we kind of had that period mid-year where the monthly returns were so bad.
Yes.
That I don't think anyone could have predicted that with the fourth quarter,
the bounce back.
We'd have that bounce back.
Yes.
And then when we look at a return, it's actually one of the top 10 2-month returns.
That's a good point. Yeah, really good point. And who knows where we'll be in a year, but history has shown that not necessarily high odds that it's going to be negative. It's pretty high odds that things are going to look positive. Again, nobody really knows. Well, let's now transition our discussion from the markets and what's happened over the last quarter or year to what we think will be happening over the next quarter or year. So first, the U.S. economy. You and I have talked a lot about this. Service inflation looks like it's a little stickier. Otherwise, goods inflation looks like it's coming down relatively well, but that sticky service inflation could be a problem for the Fed as they look to eventually pivot. Of course, there's this risk to the soft landing approach. I think it's a little too early, at least in my opinion, to declare victory on a soft landing. We'll see if inflation continues to come down, if the job market remains strong, and most importantly, if consumers continue to spend, because that's really what propped up the economy last year. Is people spent more than I think anyone anticipated.
And we saw that trend continue in the fourth quarter, and some of the economic reports we've been getting have remained strong as a result.
Internationally, The global expansion, I think, is going to continue to face some hurdles. You know, from a monetary perspective, the tightening cycle's likely over. Cuts, I don't know. That may be a little bit uncertain, just like in the US. I'm just not sure if the Federal Reserve is going to cut quite as quickly as maybe the markets anticipate. And the geopolitical issues are abound. I mean, there are just so many geopolitical issues right now. I mentioned what's going on in the Red Sea. You mentioned the war in Ukraine. I mean, there's just, it seems like event after event after event. But I always remind folks that even though you believe these particular events will cascade in certain fashions, there's just so many factors that go into play. It's hard to know exactly how the markets are going to react. Now, when we talk about service inflation and the fact that it's been sticky, show us here on the slide what we're talking about.
Yeah, so we're looking at the light blue and the dark blue. So light blue would be a lot of those services, includes restaurant, hotel, and transportation or airfare, and then shelter costs, which would include rent. And what you're going to see in the lower circle is that those things really haven't moved much recently. And so again, that's why we're calling them sticky. And when you look on the far left, when inflation was peaking, you had all of these other factors and colors come into play. Those really aren't as big of a factor. And again, the light green that we're seeing right below that circle, that would be energy. And so energy has actually been disinflationary recently. And so again, that was where we could have upside risks. If energy prices were to go up, you know, that would add to inflation. One thing that happened last year that added to inflation as well would be insurance costs, so property and casualty.
Absolutely. Yeah, I mean, we've talked to I think on our last webinar, I believe, we had a discussion around property and casualty insurance and the fact that, you know, we're seeing consistently, I would say on the low end, 10 to 15% increases, on the higher end, 40+% increases in annual premiums for property and casualty insurance. Let's talk about market expectations for rate cuts, because I just briefly mentioned that I think the market may be a little overly optimistic about the Fed starting to cut rates.
So one of the things that really caused rates to go down in the fourth quarter was inflation coming down, the Fed pivoting to basically neutral, but hinting at 3 cuts next year. And the market actually took it a step further, so to speak, and said, no, it's not going to be 3, it could be 4. Some even came out and said as many as 6. And then we had a few come out and say it could start as early as March. And I think with the GDP report we just saw, and again, because of the stickiness of inflation, I think the market might be ahead of itself with that March cut.
Yeah, I would tend to agree. I think that's a little optimistic. But let's talk about the soft landing. You know, nobody really knows, is the plane down or not? If it is, it certainly has been one of the very few soft landings the Fed has been able to orchestrate in all of its history. But there's still, I guess, a question out there. What are we seeing here, though? We're seeing in the vast majority believe.
The vast majority, so 66% as of December, believe that it's going to be a soft landing or no recession. 23% at kind of a hard landing. And so interestingly, I think that's exactly flipped from where we were in early 2023. I was speaking to one of the larger bank wholesalers, and their fixed income teams said entering last year, they thought there was a 70% chance of a recession. And now they believe for this year, there's only a 20% chance. So again, that's kind of meeting what we're seeing in this consensus viewpoint.
So my point, told me that though, was they were clearly wrong last year, like a 70% chance that we were going to have a recession, and we had none. So, just like I've reiterated time and time again, even just on this webinar, I'm just not sure how much faith I put in that, because they were wrong last time. Now they got, what, a 20% chance we're going to have a recession, but they could be equally as wrong as they were last year.
And remember, 20% is not the same as zero.
That's a good point
And
too.
so again, with all of these potential risks we've talked about, that what goes into that 20%.
Well, let's go back to inflation, or the heat map, I guess not inflation itself, but the heat map and recessions, because the National Bureau of Economic Research, they use 6 factors as kind of their guide in determining, are we in a recession? And it's always backward looking. We're in a recession before they say we're in a recession. But right now, there's really not much here that's pointing toward recession.
Yeah, and their definition really looks at more widespread weakness occurring over multiple months. And so really what we're showing is there's only one negative factor. And in fact, in this last quarter, 4 of those 6 factors actually improved. One went down, and that was the industrial production, which again, as we mentioned, the manufacturing part of the economy is the weakest factor.
So let's talk about our market outlook. As it relates to equities, we're entering the year kind of amid easing financial conditions, and certainly we had strong momentum coming into the year from the fourth quarter we saw. It was a little choppy for a week or two, but the market now, at least as we're recording this, is starting to hit new all-time highs. So we would expect probably volatility, especially in the first half of the year. Now, we will talk in a few minutes. I think you have a few slides here, Jonathan, on the election cycle and what we typically see during election years, but that could add some volatility. We need that earnings rebound. I mean, we are expecting to have an earnings rebound to really justify the valuations. And you had touched on that. Is there anything else you want to elaborate on?
Yeah, I think good equity returns this year would be hard to project if we don't see earnings coming through.
Good point. And of course, there are other opportunities, not just by investing in US large cap stocks, although again, they were one of the best performing sectors last year, driven a lot by those US technology stocks that you made reference to, the Magnificent Seven. But there are definitely opportunities in the international markets. And presuming that we don't go into a recession, small caps provide a real attractive risk return kind of profile right now. As we point out here, intra-year pullbacks should be expected. They are very common. As a matter of fact, if we look here, what we're going to see are the calendar year performance numbers going back all the way into the 80s. The dark shaded is where the market ended the year. The red font is the intra-year low of that particular calendar year. I guess the point here is, as we look across this chart, Jonathan, there are a lot of years where there's an intra-year low that's negative. And yet, a lot of those years, the market still ended positive. So to have intra-year pullbacks, very, very common. And if we experience it in 2024, that would not be unheard of. Should be almost expected based on history. But that doesn't mean that you should panic and just get out, because as you can see, if you did get out, most years you would have missed the opportunity to recover. But let's talk about the presidential election year, because I already mentioned maybe I surprised a lot of people. They didn't realize it was going to be an election year. So for those that weren't aware, it's the election year.
Yeah, so here we're looking at average performance going back to 1926. And so again, big picture, they have been positive. Again, the market is up more often than not, so that shouldn't be that surprising. But what it suggests is potentially returns are a bit lower in the first half when there is uncertainty. And then typically in the second half of the year, you do have stronger performance. Now, in this case, they're saying third quarter has typically been better than fourth quarter. That's going back really a long time. I will say that if it's a tight election and there's a bit of uncertainty, maybe we would see a stronger fourth quarter instead of a third quarter. But
are you suggesting this might be an unusual election year?
yeah, I think so. I would think most people would agree based on what we're seeing.
Yeah, I mean, there might be other years that maybe an election year goes by unnoticed until we get closer to November, but I don't think this is one of those. I think everybody's well aware of what's happening. So with that, who should, if I'm just talking about markets and just thinking about equity returns, who should I vote for? Do markets do better when Republicans are in office, or do they do better when Democrats are in office?
Actually, the historical evidence that we're showing is the returns are really not that different, very, very similar. And again, markets are up in more years than not. And so that probably shouldn't surprise people.
Mm-hmm. I think the real key, and this was a great slide, is not to get too focused on the politics, because like anything, when it comes to investing, sometimes it's just being invested that makes the difference, not the timing of when you're invested. And I think here, that's what this chart's telling us.
Yeah, it's basically going back to 1953, being fully invested is the green.
Through that whole period?
Through the whole period. So that shouldn't surprise you that the return is high. But the left two scenarios, I don't think anyone would ever do. But on one, we're saying if you only invested when a Republican is president and you're out of the market the rest of the time, or the other one where we show what would happen if you only invested when a Democrat was president. Again, I don't think anyone would actually do it. So it shouldn't be surprising because you're just not in the market compounding your returns over long periods of time.
So back to our market outlook, let's talk about bonds. And of course, with interest rates higher, that means bond yields are higher and at more attractive levels based on it, certainly compared to the last couple of years. Bond rally certainly could continue. If interest rates at least stay steady. I mean, if they fall at some point they will. We don't know exactly when, but they will eventually likely fall. That would just be like further benefiting bond returns overall. We would suggest that you consider allocating to longer duration bonds. Short yields are probably in the process of peaking, maybe have peaked. And therefore, you've got a lot of reinvestment risk looking forward. We're going to talk a little bit about cash. But I know, a lot of people have sat on some cash, earning 5%, maybe a little bit more than 5%, feeling really good about that. But I'm not so sure that good feeling is going to last very much longer. And you're going to go through a slide in a few minutes on that, correct?
Correct. Yep.
Let's see, we say bonds continue to have favorable risk reward profile. We touched on that. They certainly continue to provide diversification. I think this time around, if there is a slowdown, maybe a recession, a market pullback in the equity side, I would anticipate bonds to act more like they have in the past and providing that buffer to performance, unlike what maybe they missed in 2022. So this is going to touch on that issue of cash and reinvestment risk.
Yeah, so here we're really looking at once we do start to see cash yields fall, how quickly can they fall? And so we're looking back to 01, 02, 07, 08, and it was actually fairly quickly. And the issue is that's where reinvestment risk comes in. Yes, you can be in a cash at 5.5%, but as that starts to fall, you could have been in a longer duration bond or bond fund where you're earning 4 to 5% yield that are in longer bonds, that yield doesn't go away. And then if interest rates fall, you actually could get a little bit of price appreciation. And so that's why we're saying it's better to start thinking of locking in those yields.
And we're not talking about like 20, 30-year durations.
No.
More intermediate durations and certainly longer durations than cash.
Correct.
So this title is great. Time heals even if your timing is off. So what are you trying to convey?
Well, we've talked about that, we're following a good year from a market standpoint, and we have uncertainties this year just like last year. So what happens if we do have a recession, as an example, and that might cause the equity markets to fall? So what we're actually showing on this slide is 4 instances of periods where what happened if you actually invested right before we saw the 87 crash, the dot-com bust, right before the financial crisis and before COVID. And really what we're showing you is even with probably the worst timing you could envision, you still made a very healthy return in equities. That's the green bar. Now, in the case of bonds, generally good. Now, here we're looking in the before COVID situation where bond yields were actually down a little bit. But in general, even with that poor of timing, being invested and being long-term focused, you still earn very good returns.
It's back to the whole cash discussion, right? We've got a number of investors, or there are a number of investors out that have cash that have been sitting on this 5% yielding cash investment, whether it's a treasury bill or a CD or high yielding savings account or something. And we just went through 2023, markets at all-time highs, and they're wondering, geez, is now the time to put this money to work? Well, this is saying, even if you time it wrong and we get, a big pullback, that money will eventually recover and it will provide good performance going forward, even if the timing, at least based on history, is off. And the real reason for that is what you've already said a couple of times, and that is the market goes up more than it goes down. So your odds of making money go up the longer you're invested.
Yep. So here on the left, we're looking at very short-term periods. We're starting with odds kind of in the low 60s. And then if we go to longer periods, we're looking at, high 90s.
So if I were to invest over 1 month, I got a 62% chance of having positive performance. If I extend that to 5 years, I've got almost a 90% chance. Pretty good odds. Acknowledging that there are 5-year periods where you end up with less than you started, but the odds are just so much in your favor. And I really do enjoy this slide. We've shown it before. I think it's been probably a couple of years since we last looked at it. But this really does speak to sometimes the frustration investors have when they're in a diversified portfolio, because what can happen in a diversified portfolio is that when, let's say, the stock market's down and you've got a portfolio of whatever, 60% stocks, 40% bonds, or 70-30, whatever the mix is. When the stock market's down, it's likely your diversified portfolio is down, just not as much.
But
So
you're stinging from the loss, so you're
yeah, you're still not happy, right?
Right,
You're still
yeah,
down.
yeah.
Oh, I'm down less, but I'm still down. So, I'm still not that happy. Then when the stock market's up a lot, you're not up as much because you've got bonds, which generally don't earn as much as stocks over time. So there you're like, great, I'm up, but I'm not up as much. So you still aren't like really ringing an endorsement for the diversification. Yet, when you look at it over longer periods of time through those cycles, you can see diversified portfolios have almost as much. And this example is showing basically equally as much. That's not always the case, but you can have almost as much return with significantly less risk. And that's what the whole theory of diversification. You get good return, less risk.
Mhm.
All right, let's now talk about SilverOak's updates. There's always exciting things going on. And of course, now we have excitement around tax season. So the 2023 tax season is starting. Tax organizers, I think, have been sent out by now. So if you haven't received it, you should be receiving it if SilverOak's compiling your return. Also, we are in the market right now for several roles, including 1 or 2 new roles to the organization. I know you just mentioned you've been doing quite a bit of interviewing, so hopefully we'll have a new team member to announce by our next quarterly webinar, if not more than 1 new team member. Let's touch base on our IQs, our investment quality scoring system. I think those that are on the call that are clients of SilverOak would find it of interest. How did our investments do on a performance basis?
I would say generally very good. Our large cap funds, with large cap being up, obviously had very strong absolute returns. We did see strong relative returns in growth and in many of our value funds. Mid cap was good, maybe not quite as good as large cap, but we saw, again, on the growth side, stronger absolute returns. But on the value side, we had a couple of funds actually put in very strong relative performance. I would say if there was any disappointment, it might have been on the small cap side. Small caps were very volatile last year. Our managers tend to have a quality focus. And so in a strong rally like the fourth quarter, we saw a lot of non-earners and kind of lower quality companies make the biggest bounces. So I think that was really the factor. International did very well as well. And I think what I would say about fixed income is, again, it felt like a mixed year, but at the end, because of the strong rally in the fourth quarter, our funds did really well. And in fact, municipals generally had a very good year.
Yeah, municipals, I noted were strong, and our non-traditional, we added non-traditional a few years ago, and they had a particularly strong year as well. Or unconstrained, whatever, non-traditional, unconstrained, however you want to refer to them as. So,
and they were down less in 2022, and
they
so
were down less, not more, yes.
And so you put that together, I think that area did particularly well.
Yes. Well, let's talk about our new year planning tips. Some of these are going to look familiar if you've attended a webinar in the beginning of one of our prior years. We always remind folks, don't adjust risk tolerance due to recent market performance. I know last year coming into the year, 2022 was a horrible year in the markets generally. And a lot of people were questioning, was 23 going to be a good year? Should I get more conservative? Should I, reduce my stock exposure? And of course, we advised against that. And, lo and behold, 2023 was a phenomenal year in the markets. Now, just because we had a great year don't now think that you need to, start selling those equities. As I mentioned earlier, it doesn't mean that 2024 is going to be a bad year just because 2023 was a great year. Remember the April 16th tax filing deadline. And of course, if SilverOak's not compiling your tax return, whoever is would appreciate if you get them your information as soon as possible. Remember, if you have a foreign bank account, really any foreign asset, you need to make your accountant aware of those, because there are several reporting requirements that are associated with different kinds of foreign assets, including particularly bank accounts. And as you gather your 2023 information for tax preparation purposes, if you feel like it's kind of a mess and you didn't do a great job last year keeping things organized, well, now is time to start for 2024. And you can make a note to keep information for this year a bit more organized. Take the opportunity to look through 2023 spending levels. Also, make sure that you're maximizing investment opportunities, particularly in, say, HSAs. And of course, here are the new 2024 HSA limits. These are the new 2024 401k limits. Review your estate documents. This is a great time as you're thinking about your finances to go through the estate documents. Consider if there's any changes that need to be made based on life events over the last 12 months, maybe even changes to beneficiary designations. Of course, rebalance your investment accounts, although for our clients, we're doing that on their behalf. Ensure you have proper insurance coverage. This kind of gets back to our earlier discussion about property and casualty insurance. If it's been a while, request a copy of updated credit reports. And in particular, if you have not frozen your credit, I highly, highly recommend you do so. Max out IRA contributions. Those are the new limits for 2024. Go online to request your Social Security statement. And new for 2024, anyone that has an LLC or an S Corp or other types of entities, there is a new disclosure. It's a beneficial ownership information reporting disclosure. This is required. It's under FinCEN, which is the financial division, the financial crimes division of the government. You are required to make an online filing of the owners of these entities. Now, we would recommend you do so later in the year. The deadline for any LLC or other entity that was in existence as of January 1 of 2024, they have till January 1 of 2025 to complete this disclosure. There's no reason to do it early. This is not like the early bird gets the worm here. As a matter of fact, the early bird might get punished. And the reason is, if you do the disclosure now, and then there's a change for the individual owners, that could require you within 30 days of the change to make a new disclosure. So let's say, for example, one of the owners that was disclosed got a new driver's license. That new driver's license is actually one of the triggers to require an update of this disclosure. So just wait, maybe do it in October, November, December, certainly by the beginning of next year. But I wouldn't be in a hurry to rush out and get this done. With that, we're going to come to the end of today's webinar. If there are additional questions, I again encourage you to reach out to your SilverOak advisor. If you're not working with an advisor, my number is listed here, 952-896-5701. And I also encourage you, if you have any topics that you would like to discuss in a future webinar, let us know and we will try and incorporate that into one of the future webinar topics or content. Thank you, Jonathan, again for your time.
Thank you, Shannon.
And thank you, everyone.
Thank you, everyone.
Have a good day.